Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you for joining us today. I greatly appreciate your interest, your feedback, and your comments. Please subscribe if you like the channel. Please forward us on to your friends so we can get more viewership. I started this channel as a professional's guide to looking at securities analysis. I have a background in securities analysis. I've been doing this for about 15 years now and have worked on the corporate side, working for corporations as CFO or finance leadership, and then also as an analyst picking stocks. So this is how I've seen professional investors approach investing in private companies, as also how they take companies public. And I'm trying to share this information to the general public so you get a better understanding on how professionals look at risk return and how they always take the long-term view. And the individuals who are propping up trades or who are taking particular earnings snippets and flagging that as a reason to buy, that's more gambling in my mind, and it's definitely more clickbait for the internet than it is securities analysis and investing. So I'm doing this channel to show you how professional investors look at securities. You make your own determination if you want to make an investment. That's up to you, but I'm saying this is how rational professionals will do it, and I'm trying to get this information out there to the public so you can weigh the clickbait, buy here for 10,000 return versus, or someone who's just broadcasting based on a successful earnings beat by 2 cents a share. Professional investors don't really look at that. They're much more interested in the long run and in the company as a whole, not earnings per share per se. So let's dive in here. So today we're gonna look at Exxon Mobil and Chevron Corporation. We're gonna compare the two and see which one, if either, is a good investment. Again, under our criteria, we look for 5 key attributes for a successful investment, or at least an entry point. One would be top-line revenue growth, earnings growth. Earnings we define as EBITDA, positive free cash flow and growth in free cash flow, a solid balance sheet, and well-priced. So those 5 things are the things that we look for in an investment, and we're going to look at oil now and see what we can determine with what's been going on in the market recently. So what I have behind me is the EIA's historical snapshot. This file is the EIA oil and gasoline price PDF. They published it in March 11, 2020, so it's new. March 11, 2020. Today, this is like April 5th that I'm filming this, so it's only a couple weeks old. And what I wanted to do was give you a long-term view. If we're long-term investors, if we're investing in a oil company, that oil company is predominantly driven by the price of oil. Obviously, it's a commodity. So let's look at that. What do you notice? Here, long period of time where it did absolutely nothing, a huge spike, and then if you look at this last 10-year period of time, oil has declined from its peak to here, and even recently it's fallen off even lower. So when we look at this data, I'm going to give you 10 years of Exxon and Chevron return, financial data. And it's going to be this time period here, so you're going to see a decline. And it's important to remember. Okay, so this is the historical perspective of what crude has done, and it's 2010 real dollars. What we're going to do now is we're going to update this. So we're going to come over here, and we're going to look at another EIA. Again, EIA, U.S. Energy Information Agency. And my hat goes off to these people. I have contacted them in the past when I had a question on some of the data, sent an analyst an email. I got a response back the next morning. So if you have questions on where to find something or what their data means or represents, email them. They're all, in my experience, they have always been happy to respond, and I thank them for that. So I wanted to update this. So again, March 2020, they're updating some of for the recent changes in oil. You can see here the price futures fell below $35 a barrel, a 24% decline. I think even after this, it continued to fall with Russia and Saudi Arabia getting into kind of an oil pissing match, if you will. But the point is, stock is the oil is down. We don't know where it's going to go in the future. Okay, nobody knows. So what I want to do now is I want to say if it's here and it goes lower, what does that look like? All right. So first, what we're going to do is, well, we can go. Actually, I'll go back to here and I'll show you if it were to go lower, what would that look like? Back here to our historical chart. So we're roughly here, right? 35 bucks. We've come down to here. This is saying if you go even lower, if oil continues to slide and you're in this $25 range. Now I'm going to pick a low period of 1999, and I'm going to say what do these stocks do in 1999 with a cash flow positive, with a losing money at the bottom price of oil? What happened? And that'll give me kind of a floor that if we do revert back there, what's my real low side? Then I'm going to look at the EIA forecast. What is the EIA saying crude oil is going to do out here? And we're going to look at a couple different cases, and you can make a smell check of what you think might happen. And each case will give you a different IRR. If, as a whole, you think that the IRR case was worth the downside case, then go do it. But this is how we would approach it. All right. So let's go through and let's look at, before we look at the futures, let's go look at the stocks themselves. All right. So Exxon Mobil, Chevron Corporation. This is the free cash flow, Let's go to EBITDA before we get to cash flow. EBITDA, I don't know why that's not that's better. Sorry, I should have updated these things. They don't fit right if they're not. That's better. All right. So you can see EBITDA here, you can see EBITDA there, you got revenue. All right, here we go. So Chevron Corporation, revenue a decade ago, $250 million, $250 billion, that is $250 billion, and it's declined to $146 billion. Still an awful lot of jack. So $146 billion. EBIT, so that's operating profit, that's earnings before interest and tax, or operating income on their P&L. Almost 50 billion, down to 6 billion. Last year for Chevron was a rough year. Amortization, adding that back, I get an EBITDA. EBITDA is roughly 60 billion, down to 35, declining in line with revenue. So their margins seem to just follow in line with revenue. Oil has been falling, revenue has been falling, or EBITDA is falling. I think that is pretty consistent. Let's look at Exxon. Exxon follows the same pattern. So $467 billion of revenue. It's fall to 255. Operating income follow the same pattern, 73 to 80. Depreciation, depreciation, amortization, and I get an EBITDA. We use EBITDA as a proxy for earnings. I'm not going all the way to net income. We're going to stay above that and look at the company before debt, depreciation, interest, and tax. So 90 billion to 40 billion, again declining. So no surprise if you look here, the average decline rate is 6.5%. Here the average decline rate is a little less, 0.6%. So we've got declining revenue, we've got declining earnings. We know that during this period of time, oil has declined from a peak down to probably about here, which is in line with this period in time. Where is it going to go in the future? Who knows? But right now, at least that explains what has happened previously to stock and why the stock price has been down for quite some time. So let's go forward and let's look at leverage, let's look at trading multiples, let's look at enterprise value and get an idea of the valuation of the company has received historically. So I'll come over here and provide you with, you can see the debt, cash, market cap, enterprise value, and some ratios. Don't mind this just yet, we'll get there in a second. So what we're going to do is we're going to talk about the debt for a second. Debt, 20 billion, it's increased to $34 billion. Chevron actually had excess cash on their balance sheet. If you look historically, I've capped cash at $20 billion and said anything above $10 billion I considered excess cash. So at one point they had $20 billion in cash. I'm removing 10 of that. But you can see they chewed it up. They chewed that cash up. They have very little cash, excess cash on hand. They still have, I think at this point, I forgot, but maybe $5 or $6 billion in cash. So plenty of cash to operate, but just no excess cash. Market cap, stock times share price. Enterprise value is the sum of this and this minus that. Gives me enterprise value. You with me? Enterprise value, again, is the entire company, debt and equity, as one cohesive beast. Enterprise value at multiple. So this is, if you bought the company, all of it entirely, how long would it take the cash flow, or EBITDA, to pay for the enterprise? And it ranges. It's got a high of 15.5, that's kind of an anomaly, and then you've got your low of 3.6 when the EBITDA itself was probably really, really high. If you look back in time, right? And I got a lag again. If you go back in time, EBITDA was $60 billion. That's definitely a peak. So you can see why the traders weren't giving them full credit for it. And it was trading at a little lower a multiple because they said, look, that's an anomaly. Oil, wrong chart. Oil was peaking, and so they're not gonna say that was sustainable. That's why you're seeing such a low multiple. That's why you're seeing such a low multiple here. All right, let's look at Exxon. Exxon debt 60 to 90 billion. Again, growing debt while revenue and earnings are going down. That's not good. Market cap, enterprise value. They didn't have any excess cash. So when I went through Exxon's financials, I wasn't seeing cash that was beyond $10 billion, which is the benchmark I used here. So I didn't subtract any cash from the enterprise value. Get your multiple. Average here 8.5, average here 7. Again, fairly close for companies of this size. That seems like an industry kind of benchmark. 7 to 8.5 times enterprise value to EBITDA. Debt ratio, Chevron has less debt than Exxon, although very close on a long-term average. More recently, Chevron is 1 times levered. Exxon is 2.5 times levered. Probably we'd like to see 3 at the max for something like this that's commodity driven because it can swing so badly. I'd like to see them pay this down a little bit more. Let's look at cash flow. So that's EBITDA. Let's look at free cash flow. Make sure that they smell check between the two of them. All right, free cash flow, $41 billion for Chevron, down to $27 billion, following the same pattern. Revenue down, earnings down, free cash flow down. Here we go. CapEx also declined, which makes sense. If your revenue's down, earnings down, you're going to spend less in growth and you're going to spend less in reinvesting in your business. So that's down. One important distinction here I want to make is the gap or the spread between cash flow from operations and CapEx itself. So if cash flow's operation is the cash money that they generate from pumping oil out of the ground and selling it, then the CapEx is how much they have to put back into the refineries and how much they have to pay to go build new refineries or oil wells or test it. Any gas well development that they do, that's going to be in here. The rigs that they do in the middle of the ocean, that's out here. Tankers, it's in here. So they generate cash from pumping it out and selling it, but then when they want to go fix a pump or they want to go buy a new pump, that's in here. With me? So let's look at the gap between these two. If I averaged this over the period of time, it averages, you can't see it because it cuts off, averages $28 billion. And if I average this, here it's $24 billion. So on average, they're netting out about $4 billion a year. If they ran their business and they paid cash for all of their equipment, they still have $4 billion of cash left over. So when you see them debt financing like this, what they're doing is they're saying, hey, I make enough money to pay for cash for this CapEx, but I have better uses for my cash, so I'm going to borrow a little bit, split the difference with the bank, finance the thing over time, and that gives me a little bit more free cash flow that I can give to the equity holders, I can do other things. And that's okay, I'm comfortable with that because this gap is about $4 billion a year. So they get free cash flow to equity holders. Shares outstanding, we'll just finish this before we go to Exxon. Shares outstanding, dividing these two, I get a free cash flow per share, and it's declining. It's declining with the rest of the business. You can see that, and the share price at the time at the end of the year, fiscal year average ending, is the share price, and the yield. I'm dividing the cash flow that could be dividended out, or it could be used to buy back shares, divided by the share price gives me a yield. That yield averaged 2.7%. Let's look at Exxon. Exxon, same pattern here, but here, let's look at the average. This is $38 billion. This average is $24 billion. So, interesting. 24, what did I say? I said, yeah, 38 average, 24 average. That is what, $14 billion of free cash flow. This was 4. This is 14. So Exxon is generating, I'll take this year as an example, $55 billion of cash selling oil. They put another $30 billion back into buying new equipment, and they can pay all in cash for what they generated in a single year. They can go and they can pay for an oil well that's going to generate oil for decades. That's very interesting. They choose to finance it, that's why they have debt. So they're not paying all cash. They can have some of that cash left over for the shareholders. And you can see that's above 10. I said it was 14 was the difference here. That's higher than 14. It's in the low teens, which is about appropriate. So my point here is despite the fact that revenues falling, earnings are falling, cash flow falling, this spread here is strong enough to continue to kick out free cash flow. And you can see it the same thing here in Chevron. Right, it's smaller because of where they buy their facilities, what they're trying to do. Chevron's being much more of a diversified energy provider, whereas Exxon's like, no, I'm just an oil provider. That's all I want to do. So their margins are a little more consistent because I think they're just better at it. But this also has the same kind of patterning. Forgive me, I'm getting a lag. There we go. So again, the spread here, they could pay cash for all of their equipment. That equipment is a oil well that sits in the middle of the ocean for 15 years, and so and continues to generate revenue. So I think these guys are well positioned. They're able to make a spread between what the oil is trading and their operating costs, and that's pretty consistent over the years, despite a declining oil price. That bodes well. All right, so let's just keep going. I'll put this back. Go forward. That's cash flow. Average yield 4.4, average yield 2.7. This is a stronger yield despite having more debt. It's a really good yield. This yield, I'd like to see it up a little bit more, right? Especially in the commodity business, there's some risk there. But good perspective, excellent free cash flow in both of these things. And the way a business is valued, certainly on a discounted cash flow basis, you have to discount the cash flow. So that bodes well. It helps bolster if revenue's declining, earnings declining, but cash flow itself is strong. That's a good thing. Okay? So now what do we want to do? We've established that this is the range of oil. We've said that the financial data we're going to look at is this range here, and in that range they still made positive free cash flow. You notice that all those years were positive. Let's go look at the 1999 period of time. Were they profitable when oil was this low? So I might have you watch that a little bit. But let's go through. So this is 1999. So the cool thing about being public is you can go all the way back and get lots of data. So what I did is I said this 10-year period isn't really indicative of where this market could go because it's so broad. In 1999, what was the oil price in 1999? 1999, it's sitting around 20 bucks in here, and this is 2010 dollars. So 2010 dollars, it's about $20. Yeah, 2010 dollars. It's about 20 bucks. If I stretch that forward in time to today's dollar, it's about $25 of oil, just adding 2% inflation. So if oil is 25 bucks in kind of relative terms, let's look at Chevron. Chevron's revenue, 36 billion. Today's dollar is $54 billion. EBIT, depreciation, and EBITDA, $7 billion, or $10 billion in today's dollars. I'm just taking 1999 and I'm growing it with inflation at 2% for the 20 years difference between then and today. And you're seeing that back then they were still profitable. All right, so oil is down at $25 in today's dollar oil back then, and they're still making $10 billion a year. That's awesome. Let's go look at Exxon. Exxon's the same case, they're just larger, right? So this, I think this is Chevron's pre-Texaco merger. I think that's right. Did I put that note? Yeah, it's prior to the acquisition of Texaco. That's why this is so much smaller than this, because they bought Texaco a year later. Anyways, so here we go. $185 billion. That's in 1999 dollars. I grow that to today's dollars. It's $250 billion. So still very strong in revenue. EBITDA is EBITDA is 20 billion or $31 billion in today's EBITDA. So again, profitable. Let's look at enterprise value and multiples. Just real quick to move this along. I'm just kind of smell checking where they are, what the market traded at. So you can see enterprise value 68. Again, didn't buy Texaco yet. They're trading at 10 times, leverage 1.5. So their leverage here hasn't really moved. Chevron has been conservative, continues to be conservative. That's a nice thing to see over the long term. Exxon's the same thing. They've actually increased their debt recently, which I'd like to see them bring back down to an average, is where there's 1.5 times. 15 times multiple is pretty high, actually. They've traded down a whole lot from there. It's probably just the unpopularity of oil among kind of the millennial, early generation people. But you can still profitable. So let's go back to our chart. All right. What are we saying? We've got revenue down, earnings down, cash flow is still strong. They're still making a solid spread between what the oil price is and their operating costs. So that's nice to see. Even back here, they're still profitable. They're still spitting out cash flow. So if you had invested back here, you're still getting strong dividends between then and now, which is cash flow for us. So now what do? We've looked at Exxon, we've looked at Chevron, we've looked at Exxon, we've looked at their 10-year financials, we've even looked back 20 years to see were they profitable at really, really, really low oil. Now, what do we do going forward? Who knows, right? Does oil crater and go back to 25 bucks, which we said, okay, they can make money. You're not going to make money on your stock if you buy it, because the stock's going to continue to go down. But it's not going to go to zero because they're still cash flowing. They still cover debt service, they still kick out cash, they're still okay, they're just smaller. What happens if it stays roughly the same? What happens if it goes up? Let's look at EIA's estimate. Outlook 2019. So it's a little stale. Granted, they only do the long-term forecast, I think, annually, so we haven't seen the new one come out yet. But it says in here two things. One, the demand for fossil fuels is still growing. I'll show you that, and then I'll show you the pricing targets that they have out to 2050. Again, this was done prior to the decline that we're seeing. But if you read even in the update that they did, they said that they expected to rebound to some degree. This is looking out far enough. I think you're going to be fine when it comes to long-term demand. And then it's saying what makes up that growth. So if growth of energy growth is increasing globally, you'll see here the green line's renewables. I don't think there's any surprise there that renewables is growing at a very, very fast pace. But what you'll also notice here, petroleum is growing and natural gas is growing. So these guys here, Exxon and Chevron, they predominantly in these two categories. those categories are growing just at a slower pace to renewables. So that's one thing. Demand is still going to grow. And the next thing is we want to say what price they have for those end products. And so here's their price forecast. So what we're going to do is we're going to say we're out 10 years. That's the forecast we do is 2020 to 2030. So at 30, you got a low base and a high case. And all I'm doing is I'm saying these are 2018 dollars. So there's no inflation in this. This is real dollars. The real case is it stays roughly flat. And I think I said this is about 40 bucks. So here's 25 and 50. That's about 40. This is 75, and that's 150. So there's three cases. And you can see that right here. I'll zoom in so you can see it. So all I'm doing is I'm just pulling the high, the base, and the low. 2018 per barrel from the other report, 150, 75, and 40. Current crude price is $32. So what's that change? That percent change is pretty massive. So they're saying out in 10 years, they expect a low case of 160% increase in the price of crude oil, all the way up to a 600% move on a high case. I think 190 is really lofty, but it's a case. And what I'm doing here, by the way, if it's 150 and 18, right, we're going to grow it for 10 years because these are 2030 estimates. So all I'm doing is I'm saying the difference between 2018 and 30 is 12 years. I get an inflation of 2%. So I'm compounding that. 150 at 2% inflation for 12 years gives me $190. Simple. Okay, so now we have a base, low, and high case for where we think crude oil could be a range, a very, very broad range, basically 3x, almost 4x from the low to the high, which is a massive, massive range. So let's look at this. Let's say what ranges, if I were to look at historical pricing, and if I said our forecast here for today's dollars, okay, today's dollars, 150, 75, 40, if I push this onto Exxon and Chevron, historically, went back and looked to see when oil was in these range, what financial performance did they get? That would give us an indication of how much they may earn at different prices of oil. So all I've done is okay, the last dozen years, when did I have $150 a barrel? Never, really. But I took a high case, 2011, and I'm going to peg 2011 financials for Exxon and for Chevron as my high case. Does that make sense? So in 2030, in 2018 dollars, that's the price of oil in 2030. Again, in today's dollars, I'm going to assign that the financial performance of Exxon and Chevron of 2011 will be indicative of how they perform at a kind of a peak oil scenario. Then the other two cases, the base case is 14 and 15, and the low case is 16 and 17. All I'm doing is saying EIA has said oil is going to be 150, 75, and 40 in 10 years, in today's dollars. I'm going to look at the financials for those companies and say, okay, during that period of time, during these years, what was their EBITDA? What was their free cash flow? That'll give you an indication of where they'll perform at that level of oil. All right. So let's put back up our financial model. We'll start with Chevron. We're going to come down to the EBITDA section, and I'll just make this bigger so you can see it. It's going to be easier to read this way. So here's my EBITDA, here's my high case, and I'm saying the high case, I'm taking what we said 2011 financial results, which represented peak oil at EIA saying 150, they were only $101. So I'm saying this is going to be the peak case in 10 years. This is 2011 pricing, right? You have to adjust for inflation. So in 10 years from today, the high case is basically 2011 financial results, grown for inflation to 2030, 29 versus 2011, 2% interest gives me $86 billion in EBITDA. I did the same thing for our base case. The base case was these 2 years. Let's see what dates they were. That was 14 and 15. So 14 and 15, I'm just averaging this performance. Again, we don't exactly know how they're going to perform, but I'm saying I can look back in history and say at that level of time when oil was in this range, this is an average of $70, right? Average is 68. I'm calling that's the 75 range. So I'm going to say in the 14 and 15 year, that's how they would perform if oil was at $75. So at oil $75, they produced an EBITDA averaging these two numbers. I then adjust that for inflation because 10 years from now is when we're trying to forecast price. I get a $50 billion EBITDA. Low case, same thing. Take the low end, inflation gives me $30 billion. I then go up and do that for cash flow. So cash flow, same principle. Free cash flow to equity, I take the top number, grow it for inflation, the mid-range. And I only did one, I didn't do these two because this, if you look back, it's pretty abnormally low. It didn't smell right, so I just took the one data point. And in the low case here when oil kind of bottomed out. Then all I'm doing is I'm just taking whichever value I want and I'm plugging it in to the end and spreading the growth over time. To say they're going to get from here, I haircut cash flow 50%, and I say they're going to grow to my 2030 target over time in kind of a smooth way. Who knows? I don't know. But it gives me an end target, which is what my 10-year price target is based off. It's based on this with the average yield that we have had historically. I know I'm going fast, but there's a lot here. I'm just trying to rip through it because it's really, really interesting. So we're getting to the better part. I'm going to go to the bottom now, and I'm going to look at, this is again Chevron. I'm taking these three cases, I'm pumping them through. In this case, I'm on the base. Here's the base number. I apply an EBITDA market multiple of the average of 7.1. I get enterprise value less debt plus cash gives me market cap. Again, speeding up for you. And then I get a forecast future value stock price of $160 as the base case for Chevron. All right, let's go look at Exxon. Again, I'll just raise this so it's easier to read. I've got same thing. I'm just pulling the cash flows, forecasting them forward, and I've got a free cash flow to equity holder for Exxon, 747, 481, or 350, 342. That's a broad range. Again, that's kind of doubling. It's a wide spectrum of where you can find it following the same pattern. A haircut next year's cash flow because everything's going on. It's going to be nuts. And then I'm pegging the 10-year number as one of these and just smoothing the growth in between time because who knows. And I'm saying in 10 years they will be earning $4.81 because the oil will be in the base price of $75. With me? All right. Same thing for EBITDA. Here's my EBITDA, high, base, low, pushing here, coming through and getting a share price. Now, let's look at the fun part. Now, let's look at the IRRs. So here, I'm going to go back to split screen. There we go. Perfect. Got it. All right, now I've got Exxon over here, Chevron over here. Let's go look at the returns. Before we get there, let's look at the splitting of price. So, as of the close on Friday stock price, Chevron's $75. All right, Exxon's $39. I'm pumping through the base case right now, and I'm splitting the base case and the free cash flow with the base case of the EBITDA multiple to get an average price of $1.26. Same thing, average price $1.14 on the Exxon case. Now let's go up and look at the discounted cash flow. Here's your discount cash flow for Chevron. Here's your discount cash flow for Exxon. Again, I'm buying at Chevron in $75. I get the free cash flow that we estimate as they grow to the base case here, and I sell out at the stock price that we said in 10 years. I get a cash flow. I discount all that cash flow back at an IRR, and I get 8% return for Chevron. I get a 17% return on Exxon. This IRR is your internal rate of return. It's an annualized rate, meaning that over this entire duration of 10 years, every year you get this rate. It's also the same rate that makes net present value equal to the current price. Net present value equal to 0. So if you're looking for a discounted cash flow method, you're basically taking these, doing an NPV. If the NPV is 0, that's the IRR. All right? Or you get a 2 times return, cash on cash, 3.6 cash on cash. So now let's look at the different cases. So this is the base case. Let's look at what happens in Chevron if I take the base case and I go to low side. So low side in Chevron, low side on Exxon. So the downside here is not if it hits the $25. That would be even lower than this. This is EIA's low side case of $45 per barrel in 2018 dollars that we then forecast forward, right? So low side, basically I get 1x back. I get my money back on Chevron, negative 1% IRR. Exxon, it's a little higher actually. It's 12% on the base case, 2.5 times my cash. It's pretty interesting. Let's go look at the high case just for fun. And to give you a call, the high case was $150 a barrel oil. We didn't have an illustration of what these companies perform at that level, so I said $100 barrel oil was the case. So I think if you actually got 150, there's a chance you could even outperform these numbers. But for the sake of an illustration, this is what we have. So at a high case, $150-ish a barrel oil, you can see the upside really grows. So Chevron, 21% IRR, 5 times your money. The high case here, 25% IRR, 6 times your money. Whew, so that's a lot. What do we do? Let's recap. All right, we looked at global pricing, and we said here that pricing shot up unusually high. You can see it peaked here, $125 in the 2010 real dollar per crude, and it's declined for the last decade. What's going to go on in the future? Nobody knows. What can we surmise? We can say, well, we've got a spread that's going to go out like this. It could also continue going down. I think if it continues going down, you'd be below the low case I just showed you, so you would be negative return. But I don't think the company would go out of business because back here they still were able to produce cash flow. It'd be cash flowing, but the share price would just be less. EIA says it's not going to happen, that we are going to go north. The common language in the oil industry is that the best cure for low prices is low prices. I don't know if that's true or the saying, but I mean, the last decade has been declining and low prices have not cured low prices, so take it for the grain of salt, I guess. But I think you are bottoming out, and they are saying that it should revert north, and if it does, the base case of the EIA forecast is basically 0 return or a small loss over the decade, which isn't good. Let's be honest. Nobody wants this. On the Exxon case, it's actually pretty nice. The base case is a 12% IRR. That's a fantastic base case. High case, again, high case would be 25% phenomenal. High case here would be 21%. So I think what you got is you've got companies that generate cash flow from their operating activities. And they make cash sort of regardless of the oil price. It does shrink, yes, but it's not like they go negative. So there's some protection there. And they have solid balance sheets. So from a risk perspective, my downside here is I think the share price could decline, but I don't think they're going to go out of business. I don't think either of these are going to go out of business. They have tremendous economies of scale, and I think there's a lot of other producers that would go under first before these guys did. So the balance sheet I'm going to rely on is going to backstop the investment, and they're going to be able to capitalize through their economies of scale. What's the upside? The upside's pretty nice, okay? So the upside in the Exxon case is 25% or 6 times your money. That's outstanding. I haven't seen something like that yet as we've gone through it that has a track record of generating cash. Yes, there's lots of companies out there that show hockey stick growth curves and you can get a number like this, but none of those are free cash flowing today, let alone have an operating history that goes back 50 years. So I like the stability of an Exxon. I like the upside potential of an Exxon. Chevron, I also like. Chevron is a decent company. Excuse me, it's a very good company. It's a very good company. Has a very good upside, 21%. Base case is fine as well. Downside, yes, the downside is there as well. But I think in either case, if you say what's the risk, what's the reward, the risk is you lose some money, but you don't go under, so it's not zero. And the upside could be 5x your money. That's really good upside with limited downside. I think it's a buy. I think at this point, you're kind of dollar cost averaging as it goes in, and you have a nice anchor in your portfolio that kicks out solid free cash flow, and you hope that over time, the demand rises, price rises, and it rebounds. So I'm going to say both these are good. Depending upon what you want to do, you might want to pick one or the other. But I like the fact that the balance sheet is strong. I get that revenue is declining, earnings are declining. But what I like is despite that, they're able to generate cash flow. And cash flow is what we're buying. So I'm willing to give them a pass. I especially like Exxon because of the spread here. That spread is enough to pay all of their CapEx. So again, we looked at Exxon, we looked at Chevron. Despite the decline in revenue and earnings, I think the balance sheet is strong, and I think they've been beat up so hard that there's pretty significant upside with relatively limited downside. I think that makes it a buy. My name is Cameron Stewart, CFA. Thank you very much for watching Rational Investing. I look forward to your comments. Bye-bye.